What exactly is invoice financing? Is it the same as factoring and discounting? And how can it help your small business? Stick around and I'll answer those questions for you to help you decide if it's right for you in your business with your cash flow. If your customers don't pay you up front, then you're offering credit terms to them, and this is likely having a really big impact on your cash flow. It's common for payment terms to be 30 or 60 days, or even up to 120 days plus. So that means you can be waiting a really long time to get the cash into your business for work you completed months ago. Without enough cash in your business, you may not be able to pay your staff and your bills, but it may also be stunting the success of your business because you just don't have the cash to invest in the things that you need to help your business grow. Invoice financing can help unlock instant cash in your business because you don't have to wait for your customers to pay you. It's very common in the UK, it's used by both large and small businesses, and even some of the high street banks offer it. Well, invoice financing and invoice factoring are slightly different, but they do have similarities. So how does invoice financing and factoring work? Well, they are very similar in that you are essentially getting a loan against the outstanding invoices that your customers need to pay to you. You provide the finance company with a list of invoices and they will advance you some cash. Typically, this will be around 80 to 90% of the invoice value, and then once the customer has paid, you will get the balance less any fees and interest. There are some crucial differences between invoice financing and invoice factoring, which can make a crucial difference as to whether one of them or both of them could be right for your business. So the key thing with invoice financing is that it's confidential. So you issue invoices to your customer, they have your bank details on them, you are responsible for contacting your customers to get them to pay, and your customers pay you into your bank account. So therefore your customers never know that you're using invoice financing. Whereas with invoice factoring, the finance company take over your credit control function. This means that it's the finance company that will contact your customers when the debt is due, and your customers will pay into the finance company's bank account, not yours. Now, for some people, one of the big benefits of invoice factoring is that you don't need your own credit control function, so you can save some time or some money in your business if it's a function that you're performing yourself. But the flip side to that is that you're not in control of how and when the finance company are contacting your customers. And more importantly, how delicately they will deal with any issues if one of your customers has problems with paying. So we've seen that invoice financing and invoice factoring are very similar. Invoice financing is completely confidential. Your customers will never know that you're using it, whereas invoice factoring, your customers will be aware that you are using it. So this is normally the biggest consideration that businesses are making when choosing to go with one or the other. And how much does using these services cost? Well, invoice financing is usually cheaper because you are still responsible for your credit control. So you're not paying for that extra service. Invoice financing is often more flexible too, and if you find that your cash flow issues alleviate or are better than you expected, then you can normally adjust the amount of money that you have on loan from the finance company, which means that you can reduce the debt and therefore reduce your interest costs. However, because you are in charge of your credit control, not the finance company, invoice financing therefore normally has a slightly higher interest rate. The flexibility of invoice financing does make it a much better short to medium term option for cash flow issues, whereas with invoice factoring, normally the financing companies expect you to sign up to a contract of 1 to 2 to 3 years at a time. This means that it's not a short-term decision to deal with short-term cash flow issues. Invoice factoring should only be used as a medium to long-term solution to ongoing cash flow struggles. Can every business use both methods of invoice financing and invoice factoring? Invoice financing is usually suited to more established businesses with turnover greater than 100,000. The lending company will want to look at your financial history, so your accounts, plus have an understanding of your credit control function and how you're deciding which customers to offer credit to and not. Therefore, invoice financing can sometimes be more difficult to get, particularly for new businesses or smaller businesses. Invoice factoring, on the other hand, tends to be easier to get for small or new businesses. And this is because the risk is reduced for the finance company because they are performing your credit control. So if a customer doesn't pay or is late paying, then they are in control of how quickly they can get their debt from that customer. And how do you decide which is right for your business? Well, ultimately, confidentiality is usually the biggest deciding factor. If you think that your customers would not react well to knowing that you're using a factoring company, then do not go with invoice factoring. Look into invoice financing or a completely different form of finance. But if you're struggling with credit control and you don't have very good processes in place and your customers are constantly paying you late, then invoice factoring with the outsourced credit control function could be a really good option for you. But if you're still not sure if invoice financing or factoring could work for you, then I'd suggest you do a little bit more research. Talk to your bank and talk to other companies that use it to get their feedback on how it works for them. And perhaps invoice financing or factoring is not the way that you should go in your business, and you could consider other sources of finance such as an overdraft or a loan instead.